A stock represents how much of a company a person owns. So, when you purchase stock, you become part owner of the company and you are eligible to share in its profits. The number of shares of a company's stock you own compared to how many shares other investors own generally indicates what portion of the company you own. For example, Microsoft has sold over 7.5 billion shares of stock to investors. Disney has sold about 1.8 billion shares of stock to investors. So even if you owned 1,000 shares of Disney stock, you would own a very, very tiny portion of the company. Specifically, you would own about 0.00006% of the company. So as you can see, your ownership percentage of a company depends on how many shares other investors own. A company can exist for years without making its shares of stock available for sale to the public. For example, Google was formed in 1998 but didn't start selling shares of stock to the public until 2004. Tesla, formed in 2003, started selling shares of stock to the public in 2010. Nike was formed in 1964 but started selling shares of stock to the public in 1980. A company can only sell shares to the public through what is called an initial public offering or an IPO. When a company does an IPO, this is commonly known as going public. A registration statement must be filed with the Securities and Exchange Commission, or SEC, which regulates how companies behave in the United States. The filing of a registration statement is done on a Form S-1 registration before a company goes public with its IPO. The Form S-1 registration tells potential investors what they need to know about a company. The prospectus summary, a section in the Form S-1 registration, is an important section for investors to review. Here, I show an example of Robinhood's Form S-1 registration statement, filed with the Securities Exchange Commission when it was going public in 2021. Once an IPO is done, the company is subject to reporting requirements by the SEC, such as an annual report. After an IPO, the company's stock starts to trade on a stock exchange, which we'll discuss in more detail later. Here I show pictures of the two biggest stock exchanges in the United States, the NASDAQ and the New York Stock Exchange. After Robinhood's IPO in 2021, its stock started trading on the NASDAQ. Through a stock exchange, investors trade the stock amongst themselves without directly involving the company. Companies issue two types of stock. The first is common stock, which is probably the type of stock you are most familiar with. The other type of stock is preferred stock. The most popular type of stock is common stock. Owning common stock entitles you to share in a company's profit if the company decides to distribute that profit to shareholders. The part of a company's profit it distributes to shareholders is called a dividend. For common stock, this dividend can vary depending on the profit made by the company during the year. A company does not have to pay any dividends even if it's making lots of money. Many highly profitable technology companies pay no dividends at all. These include Amazon, Alphabet, which owns Google, and Facebook. These companies choose not to pay dividends in order to reinvest the profits back into the business to make it grow. Common stockholders are eligible to vote for who will be on the board of directors for the company. The board of directors oversees the major decisions made by the company's management. The other type of stock is preferred stock. Unlike common stock, which pays dividends based on a company's profit, preferred stock generally pays a fixed level of dividends. Because preferred stockholders get fixed dividends, they are not entitled to a larger share of the profits if the company does extremely well. In addition, the preferred stock dividends are paid before common stock dividends if the company decides to pay any dividends at all. And if the company goes bankrupt, preferred stockholders have first dibs over common stockholders on any money that is left over when pieces of the company are sold and all debt is cleared. Preferred stockholders don't have a say about how the company is run. Unlike common stockholders, preferred stockholders are not eligible to vote to elect board members of the company.